Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is the head of research of gold money, our good friend, Alasdair Macleod. Welcome back, sir.
It's my pleasure.
Alasdair, thank you very much for joining us. One of the hot topics out in the world these days is all the craziness going on in the United Kingdom, where the markets seem to have lost confidence in Liz Truss, the previous short prime minister. And then there was a huge problem with loss of confidence, and the Bank of England had to then go bail out a lot of pension funds and start supporting the bond market of the UK. So what's going on there? Because gold and silver were having dramatic reactions up and down to this intervention by the Bank of England. And that's, as Wall Street Silver, that's why we pay attention. Why was this such a major issue going on?
Well, I think the effect on precious metals was really from the ebb and flow of concerns that the whole sort of system was becoming destabilized. The fiat currency system was being destabilized. And the concerns were really pretty real because with this, LDI investment, basically what that is that pension funds who in a low interest rate environment can't make any returns compared with their obligations down the road. What they do is they gear up their operations through other entities and try and sort of, if you like, respond to this situation. And the consequence is that they use derivatives, and the derivatives are a mixture of credit default swaps on the one hand, interest rate swaps, and the other thing that they use, of course, is repos. And they can repo up to 7 times, and the regulators, say, well, this is all right. But what it basically meant was that the whole of the pension fund industry, on a fall in values, if you like, gilt values, suddenly found that they had calls. And the only way they could meet the calls was basically to liquidate asset positions, ergo, sell gilts. And so you had the potential for a real market collapse. So it's interesting, I think, from one aspect, and that is that not a lot needs to happen before you trigger enormous derivative calls. So that's something which I think we should just sort of tuck in the back of our minds as an important factor. But returning to the politics of it, the interesting thing was that Truss, well ahead of that budget which Kwarteng produced, said exactly what her policies were going to be. And, nobody worried about it. They thought, well, fine, well, we'll wait and see what happens. But when it actually happened, then all hell broke loose. But essentially, what Liz Truss was doing was she was trying to make one last, if you like, effort to move away from the government dominating the economy to, allowing the private sector to keep more of its profits, its earnings, whatever, because she knows that they do a far better job of growing the economy than government. Government, never ever actually manages to achieve anything in terms of positive for the economy. So she knew that, and that's what she was trying to achieve. But markets didn't like it, and they didn't like it, I think, predominantly, and this is a lesson for us. All the major players in stock markets are Keynesians, and consequently, they do not like the disruption to the status quo. Any idea of going away from government control back into the uncertainty of markets is very, very strongly resisted. And that was what we saw. That's what's triggered. What we now have is we're back on track. And that track, I'm afraid, for us Brits, is more and more government, more and more control. And the fact is we can't afford our government. It's got far too expensive for us. Yes, they're going to increase taxes even more. And when they fail to do that, then they're going to have to bridge the gap by issuing more debt, which, put more simply, basically means printing money. So this is a situation of continuing deterioration, and the one little attempt to try and get away from it was messed up, if you like.
Wow.
Consequently, that's it. We're on the way to, the sort of, if you like, the situation that happened in communist, in the Soviet bloc in, what was it, 1987, when the wall fell down, because it was no longer sustainable. We're on that path, which is very, very concerning.
It feels like something's about to break out there in the system. And
Yeah.
the point you made with derivatives, if with derivatives involved, especially banks like Deutsche Bank, that seems to be a ticking time bomb in the derivatives market. I mean, stuff can go south really quickly in this type of scenario.
Yeah, I mean, I think the point which we need to understand about derivatives is that they increased from virtually zero, 40 years ago, to, I mean, the last figure we had from the Bank of International Settlements for OTC derivatives was $600 trillion equivalent.
Yeah.
You've got a further $100 trillion equivalent in regulated markets, basically futures and options. Now, I mean, these are notional amounts, admittedly, but nevertheless, they do represent an amount of credit which is built up on the back of a long-term trend of declining interest rates. Now that that trend has reversed, it is clear to me that what is likely to happen, almost certain to happen, is that the level of outstanding derivatives are also going to reverse. That's so, in other words, we've somehow got to lose a total of up to $700 trillion equivalent worth of OTC and futures derivatives. And that's not going to happen without accidents occurring, I'm afraid. It's going to have lots of knock-on effects. And if you look at the mortgage industry, I mean, it doesn't quite work like this in America, I don't think, but you would know better than I. But over here, typically we find that a mortgage provider, whether it's a bank or a building society, like a savings and loan, as it were, what they will do is they will offer their customers or their borrowers, they will say, we will offer you a fixed rate of X% for 5 years. And what they do is that if that is taken up, they then cover it, if you like, in the OTC market. It's an interest rate swap deal, basically. That's what they do to secure the rate. And what they're doing is they're taking a margin out of what they can get in the market on a fixed rate for 5 years and then passing it on at a slightly higher rate to the mortgage borrower.
Mm-hmm.
That's going to end. That market is going to start contracting quite sharply. Mm-hmm. You've already got, I mean, we see with the problem with Credit Suisse that they're having to wind down their desks. They're shutting down derivatives desks. They're trying to dispose of derivative origination departments. And, they're not alone in this. This is really a real problem. So as far as we're concerned, this, I think, is of particular interest with respect to derivatives in the commodity space. They're going to get reduced as well.
Sorry to interrupt. You're referring to COMEX and the gold and silver futures and those types of derivatives?
Yeah, but not just them. Oil, the base metals, and anything where banks, if you like, and also producers cover themselves in futures or on the OTC market through, sort of, if you like, putting caps on things with options and all the rest of it. All that sort of stuff is going to become less and less accessible because the people who provide the liquidity, which is essentially the banks, are basically reducing their exposure. Mm-hmm. And in the broader sense, the other thing that's very important to understand is that bank balance sheets are very highly leveraged. Now, what is a bank? A bank basically is a dealer in credit. I mean, forget the idea that a bank is here for the public good. No, it's not. It's a dealer in credit. That is what it does. And if it is very highly geared on its equity base, and they see that the outlook is deteriorating, which is what interest rates are doing, then they will reduce their leverage. Now, if you look at a typical banking system relationship with the economy, how much of the GDP depends on bank credit? Well, I'll tell you, the answer is probably about 95 to 98% of all transactions settled in GDP are settled via bank credit. So if you reduce the amount of bank credit, that means that it doesn't matter whether you and I are running out to restaurants and spending money like Billio. It really doesn't matter. What happens is, with less credit around, GDP is going to go south big time. And that is basically what we've now faced. So what does the Fed do when it finds that its commercial banks start contracting bank credit in the economy? At the moment, they're doing it in financial services, in the financial sector. I mean, we've seen that, and that's why markets are basically weakening the whole way across the board. They will start doing it in the, if you like, on Main Street. And they are already doing it. I mean, it's not really all that visible yet. So what is the Fed going to do? I mean, is it going to quantitative tighten? No way. They do not take credit out of the system at the same time as the commercial banks are taking credit out of the system. What they will do is they will increase their QE to make up for it. Interest rates are almost separate from this issue in the sense of, the way in which a central bank responds to current and evolving conditions. But these rising interest rates, I can assure you, are behind a complete sea change in the way things work in the whole economy. Is going to hit initially the financial sector very, very hard. We're already seeing this with asset values going down. The other thing I might just mention as an aside is that if you look at the financial asset collateral being held against loans, this is probably at the highest level in the history of banking. Because in the past, what they would do is, let's say, you're running a business and you want to expand your production or something like that. The bank would take in as collateral, let's say, a charge on your factory or whatever. But the factories have disappeared off to China or whatever. You don't have them anymore. And you've got a services-based industry. So where's your collateral? Your collateral is financial. And what's happening to financial values? They're tanking. So what do you do as a banker? You say, whoops, this is not my environment. I'm a dealer in credit and my credit's going sour. I've got to protect my shareholders. And I don't give a damn what the regulator says. I've got to get out of it. And this, I tell you, is a really nasty situation we're getting into.
What you were talking to shift a little bit more to the Federal Reserve, and what you were discussing about bank credit and the commercial banks are withdrawing credit from the market, it seems. The mortgage market here is freezing up. The housing market's coming to a complete standstill. Everyone's still projecting a couple more rate hikes here with our own Federal Reserve at the next meeting, and possibly in December, 75 more basis points, another 50 basis points. We're going to be at 4.5% on the Fed funds rate pretty soon here in the United States. And as gold and silver investors, we're always wondering, or at least the last 6 months we've been wondering, when does this end? I mean, at some point, the economy freezes up, credit freezes up, the bond market freezes up, and that's when the Fed has to do something. They have to make some sort of shift. Do you sense that we're getting close to that point, or do you get the sense that the Fed's still just going to keep raising rates, and just ignore it all, Paul Volcker style?
Well, the Fed has no alternative but to raise rates until the system breaks. It's as simple as that, Jim. As to the effect on gold and silver, this I think is worth discussing. The reason it has an effect is because the people who are driving the price are basically hedge funds and, if you like, funds of that sort, not individuals, not high net worth individuals, whatever. It is hedge funds. And what they're looking at is a trade which is very, very simple. You buy gold, sell dollar, or you sell dollar, buy gold. Never take delivery. Yeah, that is what they do. So what they're looking at, if you like, is the relative return on the dollar versus gold I mean, gold does pay an interest, but you've got to actually have it in order to pay the interest. So the further that interest rates rise, the more disadvantageous it is for a hedge fund to go long of gold contracts.
Right.
So that is one thing, one side of it. Now, the other thing to bear in mind, and this gives you, if you like, the right philosophy to approach the whole of the subject. The other thing to bear in mind is that in the 70s, at the beginning of 1970, I think I'm right in saying that the Fed funds rate was around about 6.5%, 7%, and gold was 35, raised up to $42.22 an ounce. At the end of that decade, interest rates were up to 20%. Now, under this idea that interest rates are bad for gold, you would have thought that gold would not have gone up to a peak of $850, but it did. The answer to this really is that while the paper market, which has expanded to suppress the price of gold and silver, is still in charge, then you're going to get concerns of this sort. But we are rapidly approaching a situation, as I said earlier, whereby the Fed will raise interest rates until the system breaks. Now, the last time the system broke, it broke in a relatively minor way. And that was when Lehman failed. Now, I know you might think my use of the word minor is perhaps not justified, but compared with what I see coming, I think it is justified. What happened then was that the price of gold fell from just under $1,000, I think, down to around about $680. Why? Because all the Keynesian boys were running out of what they perceived as risk into what they perceived as safety, which was the dollar. And it was only later that you had the sort of, if you like, the double think, and they thought, well, hold on a minute, this is actually really very inflationary, and perhaps we ought to have gold and silver instead. So you had the sort of backwash, as it were. I think the same situation now. I mean, the uncertainty ahead of the event is obviously suppressing the price of gold and silver, because the Keynesian and monetarist cohort think that safety is in the dollar. And we're seeing this with all the major currencies tanking against the dollar. It's not that the dollar is good, it's just the least worst of a bad bunch. And I think that, at some stage, when the crisis is actually more visible, you will suddenly see that people are actually going for gold and silver. We are already seeing this with withdrawals from COMEX. I mean, COMEX is not meant to be a market which provides physical stock. It's meant to be a market to trade around it. Yeah. But you look at the bullion running out of COMEX. I mean, it's quite remarkable. Particularly silver.
We'll put the graph on the screen right now. But it was 150 million ounces in registered a year and a half ago. Yeah, it's at 36 million now. I mean, it fell 2 million ounces just yesterday.
Exactly. I mean, Jim, it's a combination, I think, of two things in the case of silver. On the one hand, you have industrial demand for it because it is such a valuable metal in this ESG world, where we're all trying to talk down fossil fuels and talk up, windmills and Lord knows what. That should not be underestimated as a driver behind the silver price. But the second thing is that there are people who do realize that silver is a monetary metal, and when the fiat currency is failing, you better have some. These are not sellers. These are hoarders. They're stackers, if you like. And we've got the same thing to a lesser extent in gold, because gold does not have that industrial use. But nonetheless, the monetary side of gold is suddenly beginning to come into the fore, which is why you're seeing consistently huge amounts of gold running out of the door on the COMEX market. And not only that, but the cost of refining and processing and all the rest of it gone up hugely for the Swiss refiners. So you can see that the whole situation, mining also is very, very fuel intensive. You can see that the situation is actually working against that mine supply. But the main thing is that the demand is being triggered by increasing concerns in places like Germany, France, China, India, in this country to an extent as well, about the future of these, of the banking system, of the currencies, which they see falling. It makes an awful lot of sense to hoard some gold, and they take on gold not to profit from it.
Right.
That is not what it's about. It's actually, at the end of the day, you want to have it so that when the currency goes, you've got something to spend with. And that is the vital point. So we are at a bit of a crossroads here. And I would say that this is a wonderful opportunity. I mean, when you see the hedge funds selling down their contracts, going short of silver, gold contracts, whatever, simply because they're scared of rising interest rates and what that's going to do to spreads and all the rest of it.
Right.
I mean, what a wonderful opportunity for people who actually genuinely understand economics, catalactics, which is really what money is all about, money and prices. I mean, thank you very much. That's where we are.
Yeah. Well, Alasdair, thank you very much for joining us. We really appreciate it. The audience loves hearing from you. And we're going to get your update again in the next 2 or 3 months. We really appreciate your time, sir.
You say the nicest things, Jim. Thank you.